Greetings, everyone. My name is Kyle McLean, and I'm a partner and senior wealth manager here with Rame and Gorell Wealth Management. Today, we'll be covering one of the most potentially lucrative strategies within the Chevron Employee Savings and Investment Plan, the Mega Backdoor Roth. This strategy gives Chevron employees a way to turbocharge tax-advantaged retirement savings beyond normal IRS limits. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. So without further ado, let's jump into today's topic, the Mega Roth. So, what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within the Chevron ESIP. By undertaking a series of transactions, employees can accumulate Roth savings beyond normal IRS limits. For instance, in 2025, employees can contribute $23,500 either via pre-tax or Roth contributions, with a catch-up contribution of $7,500 available if you'll be 50 or older by the end of the year. The Mega Roth allows certain employees to add tens of thousands of additional Roth dollars to the plan annually. I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2025, employees can contribute $23,500 to the pre-tax or the Roth account, or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all of your contributions and your growth will be taxed upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, and therefore all of your future growth and your original contributions are tax-free upon distribution. The determination of whether an employee would want to make pre-tax or Roth contributions is entirely dependent upon what their current tax rate is versus their anticipated future tax rate. If you'd like a deeper analysis of this topic, please see our pre-tax versus Roth contributions video. Concurrently with your pre-tax or Roth contributions, the company will be making an 8% matching contribution, which is also pre-tax. Based on the contributions discussed above, the total going into the ESIP for an individual maximizing the pre-tax contribution and making $300,000 per year is $47,500 from a combination of the employee's contributions and Chevron's. This $47,500 is well below the IRS maximum contribution for all sources of contributions, which is $70,000 for those under the age of 50 and $77,500 for those over the age of 50. So, where can this $22,500 difference between the IRS limit and the other maximum contributions go? You guessed it, the after-tax account. Let's discuss the tax features of the after-tax account, because they're a bit of a blend of the tax features of the pre-tax and Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid from the funds. However, growth that occurs while in the after-tax account is taxed as ordinary income upon distribution. So, you might ask yourself, why would I contribute to an account with no current tax bill reduction, but all of my growth will eventually be taxed as ordinary income? It's because we don't leave the funds in the after-tax account to grow indefinitely. The Chevron ESIP allows participants to roll these after-tax funds to a Roth IRA. And the best part? The conversion can be entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into the after-tax account. Subsequently, these additional funds are rolled over to a Roth IRA where you will enjoy tax-free growth until these funds are distributed during your retirement years. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k participants outside of Chevron cannot use this strategy. While some large companies do have this capability, if you look at all eligible 401k plans in the US, only about 3 in 10 offer the Mega Roth functionality. Let's consider a comparison of an individual who fully utilized the Mega Roth strategy over the course of their career with $1 million of earnings within the Roth conversion account versus an individual who alternatively diverts the funds into their brokerage account. Given that the Roth earnings are tax-free, while the brokerage account earnings will generally be subject to a 15 to 20% tax rate on long-term capital gains, and an ordinary income rate of up to 37% on interest income or short-term capital gains, the differential is at minimum several $100,000 of needless taxes paid. Before we wrap up our conversation today, I'd like to draw your attention to a few important considerations surrounding the Mega Backdoor Roth. Chevron ESIP contributions are separated into basic and supplemental contributions. Basic contributions are the first 2% of contributions from each pay period into any ESIP account. Basic contributions are required for the company match, but attempting to convert basic after-tax contributions into a Roth account results in suspension from the ESIP. Supplemental contributions are all contributions made above the first 2% and are not subject to the same restrictions, making them the preferred source for Roth conversions. In order to maximize the company match while also making way for the Mega Roth strategy, it's important to calculate your contribution percentages early in the year to avoid complications. If you would like assistance with this process, our team has a wealth of experience helping Chevron employees implement this strategy successfully. Another consideration is that if you have a pre-existing after-tax balance within the ESIP or growth on recent after-tax contributions, there is an added component to this strategy. In addition to rolling contributions from the after-tax account to a Roth IRA, Chevron also allows for any growth on these contributions to be rolled to a traditional IRA. This effectively negates what would be an issue due to the pro rata rule. This transaction requires supervision for successful completion, and these numbers are different for everyone. So we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert, such as our in-house CPAs, who can help you understand the tax implications of any future conversions. Thanks again for spending some time with us today to learn about the Mega Roth strategy. At Raymond Gorell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.